All right, now to stocks. And your next guest just raised his year-end S&P 500 target to 6,600 from 6,300. But 6,600 does not really imply any more upside to the market, at least for now. And there are still many risks that lurk underneath the hood. Let's talk about it all with Scott Chronert. He is U.S. equity strategist at Citi. Now, Scott, you just wrote that the S&P 500 is moving down, quote, two parallel paths. One of those is the mega cap tech growth stocks we talk about all the time. But the other one is a little more of a balanced part of the index. What do you mean by that? And sort of which one do you see kind of winning out over time?
Yeah, Brian, this is a really good and important topic for anyone looking at the equity markets right now. The parallel path is essentially, in our work, you've got roughly half of the market capitalization of the S&P 500 attached to this AI tailwind, the infrastructure spending and all the activity that comes with it. That leaves the other half that's more susceptible to more traditional economic metrics, monetary policy issues, and the geopolitical spectrum. And so our point is that when you look at the growth setup for this year for the S&P 500, consensus has it around 9%. Literally half of that comes from the Mag 7. So you see the point here. We have a fairly bifurcated market that is beating to a couple of different drummers. So we've got eyes on many different balls in the air right now.
Yeah, you also wrote about what you call a thinner left tail, the left tail, in EPS, earnings per share growth distribution. What does that mean?
Well, there's a win by winning and there's a win by not losing, right? So when you look at the S&P 500, we talk about this construct of broadening from an earnings growth perspective, which should drive performance broadening. Well, how do you get there? Well, one of the aspects of this is if you look at the S&P constituents right now, roughly a quarter of them are set up for negative year-over-year earnings growth this year. So as you go forward to 2026 and you look at what's the argument here where that left tail, those companies with negative earnings growth, begin to switch to a more positive earnings growth dynamic, that tail then provides an aspect of earnings growth into next year that we don't have this year. Point being is that we look for growth acceleration next year. What do we need? Parallel market. We need that persistence of the mega cap growth AI playbook unfolding. But we also need the rest of the market showing its own earnings growth acceleration. Yeah. A lot of this is going to be from negative to positive.
So I guess let's talk a little math, right? Why not? It's Monday, Scott. If the Mag 7 or Mag 10, let's say that the top 10 names of weight, which to your point are about half the index now, that they don't do anything for the next year, right? I hope they do, but let's say they don't.
Right.
And the other 490 start to finally outperform. Does the 490 outweigh the 10? Could the market still go up if those 10 don't outperform?
I'd say that we'd be hard-pressed to see a dramatic upside to the markets if you don't have that AI-exposed cohort participating.
Isn't that amazing? Okay? I completely agree with you because it's just math. It's 50% of the weight, right?
Yeah, yeah.
But isn't that amazing that 10 stocks run everything?
No, I mean, you can for some period of time, but I think, the way we talk about it is that what does a healthy market look like? And a very narrow market is typically perceived as not particularly healthy because there are too many implications for the importance of that very narrow leadership. Mm-hmm. So you want to see the broadening as sort of as a sign that the underlying economic trend is going your way. It's supporting a broadening down many different paths, other sectors that kind of tie back to what we were talking about in your last segment on geopolitics. But the bottom line here is that, no, you can go higher for some period of time. But if we're talking about a structural bull setup, which increasingly is our view, you need a broadening dynamic to persist into next year and probably beyond.
So let's wrap it up by talking about the geopolitics. And I do want to remind our viewers that we are covering this Trump-Zelensky EU-NATO meeting at the White House. They're in closed-door meetings. Any headlines, we are going to bring them to our viewers immediately. But I will ask you this, Scott, and whatever, hedge if you want to. What is more important right now to the stock market? Is it Jay Powell and the Fed in Jackson Hole on Friday? Or is it the ultimate outcome of this Zelensky-Ukraine Russia peace talks?
I'd say the former, Brian. We've been living with Russia, Ukraine for several years now. When it first started, we thought, oh my gosh, we need to, lower our valuation target for the S&P by a couple of turns just for geopolitical risk. That lasted for a few months, but then we moved on. The markets, for the most part, from a fundamental perspective, have moved on. But what you've seen as we go down this President Trump policy path is that as you put more of these issues behind you, whether it's policy related, whether it's the Iran circumstance, in the Middle East, potential upside escalation risk, as you put those issues behind you, it just gives that risk on dynamic to markets a little bit more salvo, if you will. So at the end of the day, the market is telling you it expects that the Fed is ultimately going to be lowering interest rates in the back half of the year. We think that's the right thing to do, given where we think inflation is going and where the labor conditions are going. And I think ultimately, that's probably at the margin the more important dynamic at work right now.
Okay, well said. We appreciate it. Scott Chronert, Citi. Scott, have a great day. Thank you.